we are living through probably the most distorted business cycle we've ever seen. One, because of all the legacy interventions we've had over the last 15 years, so much money in the system still. Obviously, then the COVID interventions, which extended the personal savings, which have kind of been drained right now. But at the same time, now fiscal impulse, the likes of which we've never seen before. So everybody's lens is kind of warped, and I think challenged to keep an open mind either way, even if we think it's completely stupid and unreasonable, But yeah, totally aware of the risk, feeling very uncomfortable in terms of where we are.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When Sven Henrich of NorthmanTrader.com was last on this program, he admitted he was a reluctant bull. He just wasn't seeing any material barriers that stood in the way of the ongoing bull rally in stocks at the time. At the end of the conversation, I asked him to come back on this program when his technical analysis tells him that conditions have changed. Well, Sven just reached out last night, letting me know that he's closed out all of his longs this week and moved to cash. Why? What's got him so spooked? Well, let's ask the man himself. Sven, thanks so much for joining us today.
Hey, Adam, good to be with you. And I'm pleased to report the background now matches the weather. We actually finally have summer in the UK. It was a long time coming.
I know you were getting very, very frustrated with that, so I'm very happy to hear that for your sake and for all of our UK viewers here. All right, Sven. Well, look, from the intro there, I'm sure I piqued folks' interests. What has caused you to say, "Hey, it's time to get out of the pool"?
Well, look, last time we spoke, I was hesitant about S&P and Nasdaq, but I was very curious about underlying sneaky, I call them, I believe, oversold conditions building in the market that set up for a possible rotation trade into some of the lagging factor indices, i.e. Russell. I started looking at Russell as a particular point of interest. And what I'd like to point out is just maybe a couple of follow-up on a couple of charts. One of the signal charts I was pointing to was the NIMO, because the NIMO itself had absolutely not participated in the rally, even though we saw, the market move higher despite red readings on the NIMO, and that left open the possibility that we would see one of those big up spike moves that we hadn't seen.
Okay. Hey, Sven, just for folks that aren't familiar with the NIMO acronym, can you explain what that is?
It's an oscillator that measures basically breadth in the market. Typically, you see it red during corrections. And for example, the April low, it got to an extreme level, was around -100. That's why it was setting up for a buy from our perspective. But you notice that, during the big rallies, you get these big spikes. Typically, you don't get tops out of them until you see negative divergences forming, although that didn't matter this late, late last year at all. We had that quick pullback in January. Then it was very weak. This was all part of the bifurcation trade. So a lot of our signal charts have been acting, let's call it strangely this year, simply because the market has been so bifurcated in favor of the few. And so what we had seen, obviously, is, Russell and Dow and everything else was completely lagging in equal weight in particular. So this was an odd reading here in the June timeframe when the market just kept going higher, but we didn't have any confirmation of a rally. And so what I mentioned last time was, you really want to see some sort of big breadth move upward, and that's the risk, right? That could still happen. And we just got that this week when small caps and a lot of the other shares started to really crank in. And that has consequences because all of a sudden, you go from, I mentioned these sneaky oversold conditions. I'll just show you one chart here on that front, which is also very interesting. And I think I just lost you guys. So bear with me. I'm coming back. Here we go. This is one of the signal charts that we're tracking. It was the BP NYA that's on the NYSE, the broader NYSE index. And look how in June it became very oversold on the RSI. it's one of those really, it can get more oversold, but it was just while it was holding up the 50 MA, this smelled like something was coming, and we just smacked up into overbought very quickly. And all this relates to the Russell. We just saw something we've never seen before on the Russell. Specifically, I want to just highlight that to you because it's just so fascinating. Because everything in these markets, it's like, it's like a swarm of locusts. They just go wild on the next field that they identify, right? And I've been highlighting in the Northcast about small caps. We talked about small caps, and it was a frustrating trade because it was just doing nothing for weeks at all. Okay, so let me share this chart here real quick, just to highlight a couple of points. You seeing this? Yes. So here was this. You've seen this underperformance here all year, right? I mean, this was the close here in 24. It was down, it was up, it was down, it was up, and then it was doing nothing. But it kept holding this trend line. And it was always at the edge of breaking down. And I kind of had every excuse to break down, but it didn't. And it kept really a tight, close eye on this trend line. And in process, it built kind of this rounding bottom pattern. Now, when you're in a situation like this and this thing is not moving, it's just kind of hanging in there, you're in a situation of supreme uncertainty because this could break down at any time, right? But these oversold readings suggested, well, this leaves room for something higher. And then when that CPI report came out, boom, right? Because now all of a sudden you get the sense maybe rate cuts are coming sooner than was previously indicated. But with anything else with these markets, and I hate to use the term, but just full retard here. We got 11.5% on the Russell in like 8 trading days. Usually if a fund manager gets 11% on a year on an index, they're happy. To get it in 8 days is just an absolute massive move. And frankly, I thought we were going to pause here at this trend line. Didn't matter, busted right through. And for full disclosure, we closed our longs right here because it was such a nice move, and we're looking for some sort of pullback. Kept going higher, and now notice the RSI went up into the 80s. I mean, immediately. I mean, it's clearly overbought on a short-term basis. And the Russell in the past, when it gets to these big RSI readings, it tends to have some sort of reaction. That's indeed what we're seeing. You can also see that the Russell hit the 78.6 fit perfectly along with that previous resistance here in early 22. So a pullback here makes sense. So these were just all part of the indicators that said, okay, well, now we want to be a little bit more cautious. And I'll share something else with you because the context in all this matters. First, the good news. The good news is that equal weight, which been lagging all year, finally broke out. On Twitter, or X, I posted this tweet here on the heels of the CPI report. And that is RSP. I said, with the CPI report, this market has the opportunity to do this funniest thing, and that is this potential cup and handle on equal weight. Okay. It was also consolidating tightly, right? And if you look at now what happened, we have this just incredible breakout on equal weight. That's kind of similar to the big cup and handle we've been talking about since last year on the S&P, but now we have it on RSP. And you can argue this can go a lot higher. No question about it. It's short-term overbought, you can say, and maybe there's some sort of backtest type opportunity. And notice how earlier in the year it defended its previous resistance. So ironically, and I've been in this game for a long time. I never thought of really charting equal weight as a separate standalone item, but it seems to be working pretty well. So that's the positive in all this. Now to my point of caution, because of not only suddenly this burst up in equal weight, but because of what's happening in the overall market. Remember, when you are going through a major rally like we've had. We've been up 8 out of the last 9 months. The S&P up 38% with barely a pullback. We had that minor pullback in April, what, about 6% or so. Nothing dramatic. I mean, and volatility compression, boom, boom, boom. And the thing, you know, if I want to put on my bear hat for a moment, the thing you want to see is enthusiasm and everything going up. That was lacking all of last year. And by the way, just full disclosure, we've been bullish the whole run up, and I post one little possibly negative bearish chart. I'm immediately named perma bear again. It's hilarious, but that's kind of part of sentiment, right? Because nothing ever works, and every potentially bearish pattern this year has died. Just got invalidated and died. I mean, I'm sure anyone who's been trying to short this market has been pulling their hair out at this point because the market's been so consistent. But as we now get this enthusiasm with equal weight and all the other sectors partaking, let's look at the larger context, because now it gets interesting. Because I always love, first of all, technical levels. By everything dragging up here in the last few days, the S&P had a key technical level, and I'll point that out here. This is the big 1.618 fib. That's between the January 22 high and the October 22 low. We busted above the previous highs in a nonstop rally. Here's that little April ding into the monthly 5 EMA. And we got to the 1.618 fib. We tried to poke above it. The month is obviously not over. But as a technician, I look at this and say, okay, I want to get a feel for whether this is keep in mind, we still have fiscal impulse. We still have all the happy, AI narratives and everything else. But as a technician, I want to see, okay, does this technical level produce a meaningful reaction? And several days, it's tried to poke over this. And every time it got rejected. Even this week, right? I think we got to 56.7 or so on the S&P. And then we had a gap down and it reversed. Now, this is a monthly chart. The month is clearly not over. And so we will know more by the end of the month. Does this have a meaningful resistance level that then it could possibly set up for perhaps what is maybe overdue at this point, a larger kind of a pullback correction? And I'll speak about that in a moment as well. But that's one of the kind of the key things that where kind of the red flag goes up and say, okay, this could be meaningful. Don't have the answer yet. So far, it seems to be producing some sort of reaction, and that's notable, right?
All right. Hey, Sven, and if if July ends and we haven't punched above that Feb line, would that give you more confidence in a trend change, or would that mean anything more in and of itself?
If it comes along with some key levels and structures showing signs of breakage, because even though we just, as we're recording this, we've had a bit of a pullback, nothing's broken still. I'll give you an example. It's classic. I look at the Nasdaq weekly chart, okay, which is, by the way, also one of those cautionary tales. And note, next week we're going to have just the Super Bowl of earnings, because all the big bad tech boys are reporting, right? If you look at this chart, I mean, despite all the incredible moves we've seen in individual stocks, this trend is as clean as chips. It tried to poke above it here and failed. What that tells me is, you get pokes sometimes. You get pokes to the downside, like here, for example. You can get them to the upside. But the fact that the trend then still holds. So, for example, if you thought this trend was breaking here and you didn't wait for the confirmation at the end of the week, because this is a weekly chart, you got to completely run over back here, right? The same thing here. You don't have a confirmed breakout until actually something breaks out and stays above confirmed. It rejected. And so what that tells me from a technical perspective, these trend lines remain fully intact, okay? And The Nasdaq, for example, right now today hit the weekly 5 EMA. We'll have to see if it saves it. If you see a weekly close below, you can argue, okay, we may have shot at further corrective activities. This is all part of the control aspect that we need to keep a close eye on. And so at this point, nothing's broken at the chart. It got overextended. It's pulling back a little bit. Okay, so that's one factor. The other one is S&P weekly itself. Also has me cautionary in context of the 1.618 fib. And that is the monster cup and handle pattern we've been watching for, basically since October of last year. At a 5,400 target, it just kept squeezing higher. The RSI very much overbought. So if we ever get a correction, it has a lot of room lower from a technical perspective, but nothing's broken here yet either. Obviously, that trend line is also holding. And let me just say something out of principle. We're all our minds are kind of warped at this point because we haven't seen any real correction in a long time now, right? And I can look at this rising wedge and say, oh my God, this is terribly bearish, right? If that were ever to break. Here's a little mind blower for everyone, including myself. If we had, I'm just throwing this out there because it has happened so many times in markets, and that's just a standard run-of-the-mill 13-15% correction, okay? If you were to get something like that, that would bring you right down to the weekly 50 MA, the previous highs from January 22, and the uptrend line. Now, I can't call for it, but I'm just saying totally standard fair market correction. And that would not break the uptrend. That would just be consistent with the uptrend. So I wouldn't call, if something like this were to happen, the bull market would not necessarily be over because the longer uptrend is still intact at that point. So this may actually be an interesting setup if we were to get that this fall. Can't say. I mean, we obviously had an October low last year. We had an October low the year before. Maybe that's becoming too predictable. I can't say. We got election coming, what have you. So it's one of everyone to be clear. Even if we had a 13-15% correction from here, for example, or from higher up, it would not necessarily mean the end of the bull market at all. You would have to break this uptrend line significantly and maybe even fall below this line. So,
okay. And so just for folks that are listening on a podcast and don't have the visuals, we're talking about sort of 4,900, 4,800 on the S&P?
Something like that, in that range. I think the daily 200 MA is around the 4,900 range as well. And of course, these things move about depending on what price does, right? So yeah, weekly 50 MA currently 48.76. The previous highs from January 22 were 48.18. And then of course the upturn depending on the timing of when that were to hit, and it may hit it later, right? I mean, if this goes to October, you may not even get to 4,800. You may hit 5,000 and save the trend. So then it wouldn't be a 13, 14, 15% correction, maybe a 10% correction. All to be determined, but none of this could even happen until this most recent uptrend breaks and hasn't broken, and it has room higher, right? But for now, that 1618 fib and that upper trend line clearly producing a reaction, so worth noting. And then a couple of more factors that have a cautionary just at this moment, okay? And this is a classic, and this is one of those charts I think you reacted to on Twitter, and I immediately got mocked for it.
Sorry, I did too, but just in and of itself, you have to have a good argument to say it's not going to hold this time. But I'll let you explain it.
Well, it's a yearly chart, and I brought a quarterly version as well, so we can have maybe a bit closer look at it. I mean, obviously, remember this was my bears are idiots chart from last year. It's
Right.
just that the overwhelming evidence is that markets go up on an extremely long time frame, and that yearly down years are super rare. I mean, they couldn't even get COVID right for the year, right, in 2020 because of all the interventions. And yet I love big long-term trend lines because markets seem to find relevance in them for whatever reason. And it's just curious that the 22 top ended right here at this trend line, going back to 1929. And here we had the 2000 type situation. And yeah, you can always squiggle on these lines if you want, since they are such long trend lines. But it's just fascinating that we just got back to it. And the reason I want to mention this here with the quarterly version of this chart is because it points out something else altogether, which is, noticed a big fat negative divergence right here. And see how clean this actually is. It's pretty impressive. So, I'm not saying you can't bust above it, but we've been up 8 out of the last 9 months. We hit the 1.618 fib. The weekly RSIs are very stretched. We got a negative divergence here. We're about to enter a seasonally more weak period, starting kind of, the Augusty, September, October timeframe. Not precluding new highs, but this always risks that you do get a pullback, and you can get a bad one, right? I mean, it could be just simply back to this trend line and we keep doodling, or it could be something larger, and then that's a buy for a larger trend up still. All kinds of possibilities. But I'm just noting there's a lot of factors that are coming together right now. And I have one more, not a chart, but just a kind of a factual number type situation to share. What's also happening right at this moment, and this is what happened this week. And I know I'm going to hear it. You're just sharing outdated type of metrics, but we hit 200.9% market cap to GDP. Now, the immediate reaction will be tech, so big global operators, it should be higher than the traditional Buffett indicator. When back in the day when he said 100% market cap to GDPs, it's a richly valued market. But since the era of intervention, remember here, this was the tech bubble in 2000, which was the absolute peak at the time, and then it became the bottom in October of 22. But this valuation metric, that whether you now account for a higher new normal with these big cap tech numbers, it should be noted that this level that was reached in 22 came on the heels on ungodly intervention on the monetary and the fiscal side. It was that entire bubble that was driven. And now we're back at it. And, the argument, I suppose, if you want to believe in no reaction here whatsoever, is nothing matters anymore, right? These amazing valuation expansions we've seen with multiple companies worth $3 trillion plus, blah 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 blah. This can just keep going. I will just point out, maybe raise a couple of questions here. One is, we have no history whatsoever that markets can sustain a move above 200% GDP, as is pretty much evident. I mean, we used to be in the 50s, 60s, 100 used to be kind of a big deal. Now we're at 200.9%. So by definition, I guess this time is already different, right? And so when you look at index charts and you see, well, there's no double tops anywhere, right? Because the S&P is so much higher, the Nasdaq is so much higher, blah, 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 blah. But maybe, just maybe, this could be some sort of valuation double top. I don't know. But it's notable. In any setting, this is a very, very stretched valuation market. And given what I said about the 1.618 fib, the trend lines, everything coming together, that has me curious. And so after seeing a move 10%, 11% in the Russell in a few days, which is kind of spastic, I said, okay, thanks for the gains. We'll take in a step back. And I'll close the entire discussion here. I'll let you, stop me here for a moment. But what I wanted to highlight, and this is, we're dealing with live markets and they're constantly changing. And just want to highlight one thing I pointed out to our clients, which was this week. The VIX has been so compressed for the better part of a year and a half. And we go to these compression periods. And this is what we looked at this week for the VIX in particular, which is it was tightening, it was compressing. And as Russell all of a sudden broke out and equal weight started breaking out, the VIX started rising ever so slightly and started breaking out. And what I try to do for myself and for our subscribers is to kind of keep an eye on potential roadmaps. I'm not saying they're all coming to fruition. They're potential roadmaps. And the view was here, we could see some sort of spike of the VIX back to its trend line, which has been actually very helpful this year, and then see a reaction from there. Or we can target that VIX gap at 18.5, may still happen, I don't know, and then see some sort of pivot reaction. And the reason that was the kind of point for us to say, well, let's go in all cash and see what happens. But if that then happens, we want to test the long side again. Now, something really funny happened because everything in these markets is so funny these days, okay? So today, as we're recording this, just look at the updated chart, and it's kind of hilarious because the VIX did exactly that. It spiked right up to that trend line, right? Poked a little bit above it. And so the VIX basically rose 33% in 5 days. But the S&P only 2.2%. It's insulting. It's insulting. So that's why from our perspective, we wanted to test, at least for a trade, the long side again. And so far, we do see a reaction. I don't know if it's going to hold into the weekend. No idea. Just thought process wise to want to keep testing this because, and it's the other thing that happened with the VIX on this rather minute pullback. Okay, and this is so important because you and I have talked about this chart many times. Okay, and this is the actual daily VIX. Our infamous Yellen concerned VIX chart, right? Mm-hmm. This is the compression zone I've talked about. We've had several of these in the last couple of years, and they do tend to produce some sort of VIX spike, rising volatility move. And, you can argue this has a lot of room higher. But guess what happened today? And this is where kind of the tactical orientation comes in. We saw the highest daily RSI on the VIX in over 2.5 years. Can you believe that?
Wow.
Yeah.
Just because a week before it was asleep.
Well, it was compressing, but like with this Russell all of a sudden flying up 11% in 8 days, all of a sudden we see such an extreme RSI reading. Now, the VIX can drop, it can make a new high and then make a negative divergence, and we get new market lows. Absolutely possible. All I'm saying is it's notable. So when in the context of the previous chart, I told you, well, kind of makes sense to expect some sort of bounce, right? And I always love when markets do the symphony thing when things come together. And that is this. Today, the Nasdaq got hit the hardest, right? And it's always about control. And guess what the Nasdaq did today? As the VIX hit that 74 RSI, the Nasdaq threatened to fall below its uptrend line here, the most recent one. And it's been saved again as we're recording this. If this breaks and shows a sustained break, then yeah, this is the other thing about this market that's just so unusual. Yes, you can get open gaps, and some gaps will never fill, and some gaps will take years to fill. What's been so ridiculous about this market again, and that you had to just ignore it so far this year, is the fact that you got so many open gaps that never get filled. It's ridiculous. All the down gaps get filled, never the up gaps, right? But again, it shows you how important the control pivots are. So you get this VIX reading, you get this Nasdaq threaten to break down, and what do? They save it again. This has been the hallmark of this market. So if you ask me at this particular time, has anything broke? No. Okay. So basically what I'm saying is, okay, tactical long makes sense, but now what is the sell case, if any, right? Because that's how we started the conversation. And I'll show you one chart and then I stop with this, but I'll show you an S&P weekly chart on the continuous version, which I think is rather interesting. Look, traditional technical analysis, I'd say this is a big, bad rising wedge, ugly, right? And it has all kinds of potential for downside if that ever breaks. And notice the pokes here above in recent weeks were rejected each time. And right here into that 1.618 larger FIB, and we're seeing a big reaction. What you see here now as we're recording this is an outside reversal candle on the weekly, bearish engulfing, some may call it, okay? We've seen a lot, as I mentioned earlier, we've seen a lot of fake outs this year. Like everybody has to be kind of paranoid on this front. But I will point out that the last time we saw a bearish outside reversal candle was right here, was in April, right? They saved the weekly 5 EMA, which they may want to do again this week. I can't say yet. And then more downside followed through into the rest of April, which then began this new uptrend line here. Very clean, actually. So, you can make the case, and this is obviously then depending on earnings next week, the reaction to earnings. Remember, with this tech move down now, a lot of these tech stocks are not anywhere near as overbought as they had been, right? I mean, if you see Nvidia dropping 7% in a day or something like that, you get short-term oversold rather quickly. But they have a lot to prove in their stories and their narratives. And to the extent money's coming out of tech and rotating into other sectors, they may not have as much oomph as maybe they did earlier in the year. So there's potential technically to say there is more downside to come, and we'd have to assess how deep of a pullback that could be, because there's one other consideration that I want to share with you, and it's a very simple thing. It's election year seasonality. Because that is still in the background. We do have an election year. We got our low earlier this year in April as opposed to March, so that things seems to have veered off, but it did call for a very strong rally in June. We got that. It could call for new highs in July. We got that. And now we're seeing a pullback in the latter part of July, the second half. And that is not unusual in context of an election year. But it also says that's the end of that again. So whatever pullback you may get by the end of July would then get bought. What's the argument for that? Well, guess what? Gazillions of buybacks coming back in August following earnings season, right? So then you set up then again for an October type of correction. But this also assumes that we're getting past the 1.618 FIB, okay, right, which hasn't happened yet. But it's a key level to watch, and we'll have to ascertain. And by the way, then the October lows would be lower, right, than July. I wouldn't concern myself with the percentage points. I'm just talking about the directional flow of that. And that then leaves room up for that larger correction, 10, 15% or what have you. So I think in summary, the positive here is the equal weight breakout. If that sustains, and the earnings now that are coming in, and there's a lot of expectations about small caps now picking up the baton for earnings growth going forward, then any pullback to maybe backtest breakouts or key support levels could have set up for a new buy. The risk remains, in my view, that these markets have hit key levels and there is potential for larger pullbacks. But as you can see in the charts I showed you earlier, they're still retaining control. When something is at the cusp of breaking, it gets saved. And that forces us just to continue to be tactical. So yeah, we saw key levels. We pulled out of cash. We saw the VIX all of a sudden ripping up on the end and the NDX hitting a key trend line. We want to test it because, nothing's broken yet. And we work with stops, obviously. So we're going to be very disciplined with all that. I would love to see a 10-15% correction this year. No question about it, to get something more solid that aligns. I think everything is very much stretched. But as these things unfold, we got to continue to be very mindful of the control pivots that are taking place. And of course, God knows what's happening on the political front. We got a little curveball thrown in. I don't know if you noticed that, Adam, this week.
The political curveball that happened a couple days ago.
Yeah. I mean, it's obviously we may live in interesting times again. And I'm referring to the interview Trump gave in Bloomberg.
Where he basically laid out his policies, right?
Yeah, and I'll share this one with you. This is from the Financial Times. A few months ago, Trump was quoted as saying that he would basically get rid of Jay Powell, right? I don't know why he said it, but he said it, blah, blah, blah. And now all of a sudden he puts out this. The first, I guess, to say is he would let Powell finish his term if he was doing the right thing. Now, I never talk politics. It's not my thing. I always have to keep an eye on politics to the extent that it could be market impacting. And all of a sudden putting interest rate policy front and center as part of the election campaign, I kind of have to pay attention, whether I like it or not. Okay. And so he says, if he was doing the right thing, well, what is the right thing in Trump's mind is don't cut rates.
Right. Don't touch it. Yep.
Don't touch it. And as you know, Powell has been very keen on asserting that the Fed is apolitical and they're not taking any political factors into consideration. They have to say that, right? It's the Fed independence, so to speak. Now, Powell and Trump obviously have a history as well. I can't judge this if Powell will let himself be influenced. Why would Trump even demand that? Well, we can speculate on all kinds of reasons, right? Because the longer rates stay higher, the higher the risk of lag effects in a recession, right? It's an election year. It's a tough call. We have seen Powell react to Trump before, whether he did or not in terms of public perception. It has happened, right? That was 2018.
Right.
It was the infamous flip-flop when unemployment was at 3.5%, inflation was at 2%, the Fed was raising rates and reducing its balance sheet and set the expectation with all the banks that they're going to keep raising rates in 2019. What happened? The market dropped 20% in the fourth quarter of 2018. Trump was yelling at Powell every day, basically. And then Powell flip-flopped, right? And then they ended up cutting rates. I can't make that assertion here. I'm just saying there's some history there. And obviously the Fed does not want to touch this with a 10-foot pole. But to the extent, the Fed does not follow through with rate cuts that the market now expects for September, it could cause some additional volatility in markets. So I just want to throw that out there as a potential curveball. I just found it curious that just became headline news this week following the inflation reports.
Yeah, I actually had an opportunity to talk with Thomas Honig, who used to sit on the FOMC as a voting member. I had a live Q&A with my premium Substack members with Dr. Honig yesterday, and I brought up this exact thing, Sven. And you sort of asked two questions. One, how much does that influence the Fed, right? When a sitting or potential future president, basically puts that kind of pressure on them. And then I also asked the question of, like, while the market is salivating for a rate cut, and I think the market is now pricing a September rate cut in at like a 95.3% potential. Should it, when we pretty much have, until yesterday, markets at all-time highs, real estate prices at all-time highs, surprising strength in retail sales, unemployment still, even though it's rising slightly, still at very historic lows. Those are not conditions under which you normally justify an easing campaign. In fact, they're generally conditions where you try to justify a tightening campaign. So Dr. Honig said two things. He said, the Fed is human, and while it hopes to be independent, the reality is they can't help to be at least somewhat influenced by those pressures. And then secondly, Dr. Honig's in the camp of he doesn't think the Fed should be doing interest rate cuts at this point in time, given what he thinks is correct policy, and he thinks it's a mistake that Powell has been continually trying to raise the market's expectations for cuts that he knows he can't deliver on any guaranteed timeline. And the latest example of that was he got the market all excited in December that rate cuts were practically imminent, and then here we are, 8 months later, and he's still dancing around it.
A lot of people learn foreign languages. They go to college or they learn it in their families, but there's one language that is not taught anywhere, and it is a foreign language. It's called Fed speak, and you have to teach it yourself. Okay, now I've been watching this show for many years. Okay, and I'll tell you what kind of observed and what I think my conclusion is. Okay, remember in the last few months we kept hearing how strong the labor market is.
Mm-hmm.
Every report. Then all of a sudden, Powell threw in a nugget last time, in June actually, about how the labor market may be overstated. In fact, you and I talked
We
about
did.
that.
And just to add into this too, he started slipping in during the Q&A when people would say, well, what could get you to cut rates sooner than you're asking, than you're guiding? And he would say, well, if we had a lot of sudden weakness in the labor market. He just started foaming the runway in case it needed to happen.
And then he added, suddenly, a lot of dual mandate talk,
mm-hmm.
which is unemployment. These are the subtle signs you want to keep reading in terms of shifting narratives. Remember, they came out in June also with their forever 4% unemployment rate forecast, right? Into
Mm-hmm.
25, into 26, no recession ever.
Right.
So for them to all of a sudden shift their tone and subtly hinting at that tells me that they're cognizant that the labor market may actually be a lot weaker than they thought, that it's at a lot more risk. Remember, these at pre-recessions, if there is to be a recession, it's always the sweetest. Unemployment is low, growth is still there. It's before the yield curve reinverts, right? And we've seen now the longest
uninverts, but yes.
Uninverts, yes. We've been in the longest period of inversion now since, I guess, early 80s or something like that. It's pretty extreme, and because things are extreme and no longer matter, everybody's kind of discounting it, but it's kind of poking up a little bit. Remember last year we also talked about the concept of yield relief turning to yield terror.
Mm-hmm.
I submit to you that the concept was spot on. We got the reversal in yields. I didn't bring a chart on this, but I posted one on my Twitter feed about this big diamond pattern on the 2-year. Lower yields are coming, and that was the concept of the market runway. So when yields are dropping, markets have this big relief runway. They can last months or years. But then when the lag effects do take hold, and you enter a recession, then all of a sudden you got yield terror, and dropping yields is a sign of economy going into recession. I think the principal challenge we've had, all of us in this financial market economy community, is to account for the impact of fiscal impulse. Every year they come out and says the deficit's going to be that, and every year it's going to be much higher than that, right? Last year was $2 trillion. Guess what? It's going to be over $2 trillion again this year. And it may just simply have a muting effect in terms of the runway. In the sense, it could push it out even further. In fact, I was looking at data points that would say, okay, are we actually close to a recession? Because you got the economic leading indicators on the floor. You got so many signals that are screaming caution.
Right,
and
but have been for a long time in many
we
cases.
had them for a long time. And one of the ones I like, historically speaking, is a very classic one. It's called industrial production. Even though we have such a big service economy now, every cycle, every recession you had, industrial production dropped. It started decreasing year over year. And guess what? We just got a positive 2% reading. In fact, I have a chart. I have a chart just to kind of give that a bit of historical perspective. Here you go. You look at past cycles, industrial production here, I guess in the early 90s, it still kept rising as the recession began and then dropped off. 2000, it started dropping off before the recession. It peaked right at the 2007 recession. The earnings recession here was in 2015. We've been even pre-COVID, right? It started declining, which was a red flag. Obviously, no one knew a virus was coming, but it was a red flag that the economy was maybe heading into recession. And we've just been chopping around here as of late. And all of a sudden, it's pushing higher. So in itself, it doesn't signal a recession at this point. Were it to turn, then yeah, then you would have a recession. But part of this is too because we have this incredible amount of spending on AI, i.e. capex. And capex itself doesn't show any recessionary trend at the moment, or business activity. We got that data point today. You check this out. Typically, you would want to see this, if you're expecting a recession, you would want to see this go negative. Makes sense, right? Business activity slows down into a recession. Well, we had that negative aspect of it in 22, and now we're moving back to positive. So, it's just nothing clear on that front. And as long as that's the case, I have to say markets have a runway higher, and any correction in the fall may still be a buy.
Okay, so I've got some synthesis I want to do from all the charts you walked through. So I don't want to get distracted on a topic that we could devote a whole interview to. But you just said, look, as long as what we're seeing here continues, you can make a case for a resurgence in the markets. I think one of the big questions with AI, I mean, no question at all, hundreds of billions have been getting poured into the economy, right, of capex, basically building out data centers, right, buying chips. That's why Nvidia has become, was briefly the world's most valuable company. I interviewed Fred Hickey, high-tech strategist, about a month and a half ago. And he's loudly ringing the warning bell that, look, the AI movement has gotten way ahead of its skis. We're just not seeing the ROI on the spend, and it doesn't look like we're going to see it anytime soon enough to justify the market valuation that these companies are receiving right now. And since that conversation, I have seen more and more articles begin to appear in more mainstream channels. It's not the dominant narrative yet, but it's sort of becoming this, that we're entering the show me the money phase of AI. Like, where is the killer app? Where are the companies, profit surges from implementing AI? And we're going into earnings, so who knows? Maybe we'll get some upside surprises there. But if that turns out to be like what has happened in similar periods where you've had this massive mania of, hey, world's new technology is changing the world this time, right? Whether it was the fiber optic overbuild out, or I mean, this happened even back in railways. That could be something that changes the game here, right? If all of a sudden companies start deciding to dramatically decrease their AI capex spends because they want to adopt a more of a wait and see approach, that could be a game changer, correct?
Yeah, I mean, look, we had this with the internet, by the way, right? I mean, we had fantastical expectation, we had a fantastical spend, and then we had 80-90% corrections in the perceived winners at the time. Apple, Amazon, you name it. They all got completely hammered. And now look at them, they're the biggest companies on the planet and vastly successful. It's all about timing, right? And so sometimes expectations can get ahead of reality that may take time to build out and be something practical that actually has a revenue model. You know, I'm probably the worst person to ask on the planet, but I still don't have a use case for myself. I mean, I can't, you know, I write daily briefs every day. Can I ask AI to write the briefs for me? No, because it's not intelligence, it's dumb. Because AI, even though it claims to be intelligence, is lacking an important aspect, which is called judgment. Okay, it can regurgitate data. Parrots can regurgitate words as well. That doesn't mean I'm going to employ them. Yeah, there will be cool things coming. I have no doubt about it. And I will not be so arrogant as to say that what I see today is reflective of what we're seeing a year or 2 or 3 years from now.
Right. And internet's a great example of that. Yep.
Yeah, absolutely. And if you're a company that's spending a bunch of money on servers and you don't have a killer app, and incidentally, what you're spending on servers today is going to be much cheaper 2 years from now because there's always issue of scalability, then it's called front loading and you don't have the ROI on that. So I think companies need to be really smart when and what to spend what and what are they getting in return for that. So yeah, that's the undiscovered country here in the next few years.
Right. And we could debate this, and neither of us has a crystal ball, and we'll be talking long enough in the future, Sven, that we'll see how this movie plays out. But I bring it up here because, again, trying to synthesize what you were saying earlier, the markets increasingly have been very stretched, as you've said, right? Very stretched, or we see compression and things like VIX. And we sort of have this market, almost like with a rubber band, the more you stretch it, when you let go, the more violent the contraction, right? So the market sort of increasingly has two modes, like aggressive rally or, oh my God, everything's collapsing, right?
Well, actually, Adam, just to interrupt, I mean, the radical moves, the vertical moves, they've all been to the upside. I mean, if you get a pullback, I mean, look at April, it took back and forth and chunk. Look at the Russell now, vertical up. You never get that on the downside anymore. It's so one-way oriented. It's frankly concerning. Sorry to interrupt.
Totally agree. And I guess I'm trying to figure out whether to put this in the upside or the downside. But with the VIX, a little wobble in the S&P, and then the VIX just explodes, right? Now that's an upside for the VIX, but that's kind of measured as a downside for market conditions. And then we got the greatest jump in the RSI in the VIX and whatever you said, several years at least, right?
2.5 years, yeah.
Yeah. So it just means the market is more and more unstable. And this is maybe a bad analogy, but it's like the market kind of becomes increasingly nitroglycerin. You just have to treat it really carefully because just even a littlest jitter, could set it off. So I'm sorry, go ahead.
Well, no, it's just interesting that all of a sudden we get this two-way volatility, with indices that have been lagging, exploding to the upside. and all of a sudden volatility exploding to the upside, right as we reach that key technical level, that 1.618 Fib. It's not giving you a sense of smooth market functioning, does it? So yeah, you always get the sense something could crack, but that's the issue. Something could always crack, but you need to see evidence for it. And if something cracks, fine. You know, from our perspective, then we're going to look at the next levels and the next confluence support areas, and we can make judgments along the way. But yeah, knowing that we're at 200.9% market GDP at a key technical level, does that make me want to go all enthusiastic long while everybody's chasing the Russell up 11% in 8 days? Not really. I mean, that's where I kind of go, you know, okay, so maybe, being reasonable, trying to be reasonable in an unreasonable market puts you in a position where you then ultimately may forego some gains. Fine. I don't care. If we catch an 8-9% move in a few days, that's brilliant. I'm happy with that. I don't need to chase. Zero FOMO whatsoever. I'd rather get my signals aligned, and if we see some short-term opportunities, great, we'll try to play that. But overall risk assessment, it's so high, it's so extended that if something does break, we have a lot of downside risk. No question about it. That's why I say 10-15% correction may actually be a good thing, given all that, and if it's contained to that, then that's fantastic, But this continued run up month after month after month after month, and these constant chases and exacerbated charts, yeah, they can go on, but they also can have very unhappy ending. I don't think any one of us wants to have unhappy endings.
Right. Okay. So what I'm trying to take this to is the so what for the viewer here. So what I hear you saying is, I'm going to keep using my nitroglycerin analogy, even if it's not the right one. You said being a reasonable investor in an unreasonable market, right? It's like you're carrying that jar of nitroglycerin that's becoming increasingly unstable on its own. But as you've said, and many other folks in the channel have said, fundamentals haven't mattered for the longest time, but the fundamentals still continue to get really concerning, right? You just mentioned things like 200% market cap to GDP, right? So it's like you're carrying this increasingly volatile nitroglycerin across a minefield that increasingly has more mines on it, right? So it doesn't mean you can't go a lot further, but it just means that the risk profile feels like it's getting higher and higher. And to make sure I heard you correctly, what I heard you say was, hey, we saw this this massive violent rotation happen really quickly that sent the small caps going to the moon. In one sense, that makes us feel good that the market's broadening out a little bit, but there's so much going on here that's so weird that we're just going to take a step to the sidelines and see what happens when the dust settles. So that's why you sold out and you went to cash. I don't hear you saying, this is it, guys, I'm out, we're about to fall off the cliff. You're just saying, I want to see what happens when the dust settles. And if I heard you right, you're even looking for ways to re-enter on the long side if you see certain signals that you're looking for. So you're not telling people, hey, this is it, it's the end game. You're just saying in the short term here, things got a little weird. Makes sense from a risk standpoint to just, watch from the sidelines and determine what to do next. I guess one question I have for you here is, so obviously, Sven, it'd be great for you to let us know when the dust does settle, if you go back long or you see other things that begin to make you even more nervous. But the question I want to have for you here is, can this rotation, can that save the indices? In other words, so much of the market cap is driven by these small companies that are, so tech AI driven, that we could have the other 495 stocks in the S&P do well or be up from here through the rest of the year. But if those few stocks struggle, the indices could still go down, right?
Yeah, I mean, recently we got to the point where the S&P, 5 stocks made up almost 30% of the index. You are that concentrated. I mean, the idea originally in indexing was to be diversified. If 5 eggs in the basket make such a large portion of the weight, if they drop 10-15%, the other smaller components have to do a lot heavier lifting to keep it up. So yeah, you can conceptually say you're in this ironic situation where all these others are catching up, but let's say these others, the big ones, go through a major correction. The S&P may not do anything, or may even decline as a result of that. I think the broadening out is good. I think the story on small caps, as maybe as ridiculous as it just got with that spurt higher, it may still be very positive if the earnings picture follows through. And there's a lot of expectations that small caps are going to pick up the earnings growth. So I'm still looking for opportunities. We just at this point decided to pull out and look for a new swing buy setup. In the meantime, as we're watching this all unfold, we'll use signals to test tactically what could be bounce opportunities. Remember, as I said earlier, the downside doesn't go in a straight line, only the upside, apparently. And it's a difficult decision process to noodle through, because like October 22 low, October 22, October 23, these are great swing buy setups. There was confidence, the signals aligned, and it was all coming together. This year, the market's been a lot more difficult to ascertain because of the bifurcations, the conflicting signals, and so forth. So you go through phases where you may not be very convicted to be aggressive long, i.e. for us, when we said, okay, S&P, Nasdaq can't justify new longs, we can only scale out. But then we see an opportunity like the Russell, and we say, okay, we want to test this because of such and such factor. And then you see that come to fruition. Great. But then you continue to have to reassess, especially as the overall market becomes ever more stretched, and you just don't get the sense that risk reward is really there. I mean, again, 38% in 9 months with hardly a pullback, and just pulled out a bunch of cash. Do I want to aggressively push long? No. Does that mean the market immediately rolls over? No, it doesn't mean that at all. It could still go higher. It doesn't mean the risk reward is good. I mean, we've seen that before, where risk reward is poor, but markets keep going up. But that's the danger. This is where perception gets warped. When markets become quote unquote unreasonable and engage in wild speculative behavior, the temptation is there to abandon discipline and process. That can work for a while, but it can also hurt you tremendously, because then it becomes, again, part of the psychology. And you're tempted to do things that years and years and years of experience and process has taught you not to do, because the market is so relentless, right? And that's how people end up getting hurt. That's part of trading too, is the psychology of it all, but being respectful of these phases in markets where things can seem so incredibly unreasonable. And you mentioned fundamentals. Earnings are still growing. It's when earnings stop growing and start retreating, that's when things get really ugly. The one maybe factor to watch out for this earnings season, it's been said that bear markets end on bad news and bull markets end on good news. You want to keep an eye on the reactions. So, for example, if you got a lot of these tech companies reporting great earnings, beating expectations, and most likely they will again, but their stocks still sell off, that may itself say something, right? It's when that no longer works, right? Company X announces $20 billion buyback and beat earnings by 30%, and the stock's down 5%.
Right.
What is that?
Just being super transparent, I'm awaiting, whenever it happens, might not happen for a year, but I'm awaiting the moment in Nvidia, because I think when we get there, and we'll mathematically have to get there at some point, Nvidia can't keep growing like this. When its forecast disappoints, even if it's rosy, disappoints the market, that's now Nvidia is almost too big to fail. And if that starts failing, it's going to be very interesting.
Oh, too big to fail is child's play Well, what's child's play during the global financial crisis, considering what we got going now?
Yeah.
I mean, the market caps are just absolutely astounding. And yes, I mean, any of us would have ever thought that we would see a time when we have $3 trillion plus market cap companies with forward multiples in the 30s. I mean, wow.
If you want to hear something scary about that, and I'm looking at the time here, Sven, we're going to have to wrap it up because we've gone over the hour, and I want to be respectful of your time because I know you're busy. But I just interviewed Michael Green, and one of the things that Mike talks a lot about is what he calls the giant mindless robot, which are these massive passive capital inflows that come into the market month after month for a variety of reasons, but a big one being just mandatory buying from retirement accounts from people who are working, right? A portion of your paycheck gets reserved and gets put into the markets. And that is price insensitive purchasing, right? Like an active manager like you can look at all this data and say, you know what, I don't want to buy this stock right now, given the current conditions. I'm going to wait for the dust to settle, right? Doesn't happen with these capital inflows. They come in just algorithmically. You have to buy, X amount of all these different things, right? Month after month after month. And he's basically said, and he'll say it much more eloquently in detail than I can hear, but that has created a lot of phantom value that essentially has created a Ponzi system, right? And if you get to a point where those capital flows get impaired for a variety of reasons, maybe we have a bad enough recession where enough people are laid off that the monthly amounts start dropping that are going in, right? Then you have what happens to all Ponzi, schemes where all of a sudden that phantom value starts vaporizing, right? So it's scary because the companies you're talking about, right, those three that are worth collectively like $10 trillion, a healthy amount of their valuation has come over the past couple of years, largely up, in part of the AI narrative. You could easily see, I think, trillions of their market value disappear pretty much instantaneously if what Mike fears happens.
What do you think? We got to 200.9% market cap per GDP by accident based on fundamentals? No.
Yeah, well, there you go. Yeah, exactly.
It is in that sense the ultimate dumb money, because it is not allocating based on anything relating to fundamentals. That's how you disconnect markets from fundamentals. We talked about liquidity. You talk about asset allocations. There's all these things driving the trajectory in the equation, and what worried Buffett back in the day, and I don't know where he stands on this today, is just when you get too far disconnected, whatever the right number, the balanced number is these days in the age of global tech. But if you get too far disconnected from a fundamental foundation, look even at price to sales ratios these days, they're sky high. You always risk an accident of epic proportion. And, I think you and I talked about this before, is to the extent that the economy is so financialized, with everything being correlated with markets, markets being so much larger than the economy. That's been my premise, that they intervened every step of the way since 2009, is because they are aware of that. And hence the flip-flop in 2019. If you have a larger market event, it will by itself cause a recession. In olden days, you had a 10%, 20% pullback, it wouldn't have impacted the economy that much. These days, it would, right? Guess what? That's why we had such a big intervention during COVID. That's why they bought mortgage-backed securities, even though they didn't need to, right? They did not want that recession, or they wanted to avoid it as quickly as possible. And fair enough, global crisis, don't know. But the fact that we're here now at the loosest financial conditions since 1997 or 1998, at the end of a so-called tightening cycle, it just speaks to things being out of balance the way they probably should be. And keep in mind, past rate cut cycles have also led to sell-offs. I'm not predicting that yet here. I mean, obviously 2019 did not lead to a sell-off. It led to a massive rally into then the COVID crash. But I'm just saying we are living through probably the most distorted business cycle we've ever seen. One, because of all the legacy interventions we've had over the last 15 years, so much money in the system still. Obviously, then the COVID interventions, which extended the personal savings, which have kind of been drained right now. But at the same time, now fiscal impulse, the likes of which we've never seen before. So everybody's lens is kind of warped, and I think challenged to keep an open mind either way, even if we think it's completely stupid and unreasonable, But yeah, totally aware of the risks, feeling very uncomfortable in terms of where we are. And by the way, just final point here, this highlighting how everybody's perception may be warped. In December, just a few months ago, the average Wall Street target for the S&P for the end of this year was 4,800 and change. And now that we hit over 5,600, they're trampling all over themselves to upgrade price targets. What's changed? Have earnings grown that dramatically?
No.
No. I mean, they have grown a bit. When you look at GAAP earnings, they're slightly higher than they were before. Okay. But that's part of the psychology as well. And then that invariably happens too, because people trampling all over themselves to keep up with the market. Oh, I had a 4,800 price target. Well, I better start raising it to 6,000. And notice in the last couple of months, we've seen the last Wall Street bears being chased out of town, right? Actually losing their jobs or their positions to some degree. That's kind of a sentiment check as well. So, I hear wild things on price targets all the time, but the danger is then people get run off the cliff. I hate to use historical examples because they may seem so irrelevant, but we've heard all this before in 2007 or even 2008. Bernanke, January 2008, the Fed forecasts no recession.
Right.
When did the recession start? December 2007. Thanks. Okay.
Yeah. Thanks.
They
Thanks
don't
for
even.
your army of PhDs. Yeah. No, totally get it.
Yeah. And everybody was upgrading the S&P to 1,500, 1,600 for 2008. It ended at below 900. No one knows. So keep an open mind.
All right. All right. Well, look, we got to wrap it up, but I've got two questions to ask you. I'm gonna pack them into one question, and then just give me the shortest answer you can. But very importantly, for folks that have enjoyed this conversation, Sven, and would like to follow this on a frequent basis going forward by following you and your work, where should they go? That's question number one. Question number two is back to the sort of so what. So you've said, hey, in the short term, I'm moving to cash. I'm going to sort of watch how things end up. Is there any sort of allocation advice, recommendations you have for folks right now? Or is this literally, you think, just a good time to just, I mean, I don't want people to sell their positions, their long-term positions right now, because I don't think you're ringing that bell that, hey, it's time for everybody to get out of the pool. But, if somebody's sharing your concerns here, is there any sort of allocation or positioning that you're thinking of right now, given the current reality on the ground?
Yeah. So first, on Twitter X, I'm at Northman Trader. The website is northmantrader.com. YouTube, I have the Northcast out, also at Northman Trader. So you can follow my public work there. And of course, we have subscription services via the website where we're going through all this stuff on a daily basis as we're adjusting. My general position right now, we chose cash, but we're also testing again longs because of what we see in the signals. Not a convincing swing buy yet. Basically just looking for a correction at this point. I don't think the bull market is anywhere in trouble at all at this point. I would need to see a breakdown, a sustained breakdown of any sorts. I think upside risk remains as long as this whole fiscal impulse dominance remains with us, and as long as earnings are holding up. So we will continue to have the occasional hiccups in terms of volatility. We may have a 10-15% pullback correction into the fall. I would welcome it if it happens, but also wouldn't be surprised if they, pull that rug again sooner than we expect. But also keep in mind, it is an election year, so we may get surprises that may be market impacting at some point. But for now, I'd say the rotation's positive. It just got a little crazy in the short term at a key technical level. So I want to see if maybe into the end of July we get some sort of solid pullback that may set up for another buy. That's kind of where I'm at the moment.
All right, thanks. Well, look, Sven, please keep us updated as you see how this begin to resolve. And as always, you've got an open invitation to come on here whenever you see something like you've just done that you think is notable enough to tell folks about, especially if you get to a point where you think there's a seminal shift in the market where you think that bull trend could be in danger in a way that it doesn't seem to be right now. My friend, it is always great talking to you, and it always breaks my heart that we can't extend these things out to 2 or 3 hours. I know we did like a 3-hour one once. We probably should do that at some point in time for the folks that just can't get enough of this stuff.
I'm still in counseling about that one.
Well, it's amazing that I can do that with you, and it's like Chinese food. I wake up the next day and I'm like, I want more Sven. All right, brother. Well, look, enjoy the sunshine out there.
You need help.
That's probably very, very true. My wife is a therapist, and she tells me that on a daily basis. But Sven, look, I thanks so much again for everything. Get out there, enjoy the sunlight, and keep up with the wood chopping, my friend. It looks like it's keeping you in great shape.
Thank you, Adam. Always a pleasure speaking with you, and we'll talk again soon, I'm sure.
All right. Well, now's the time in the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by lead partners there, John Lodra and Mike Preston. Guys, great to see you. Mike, let's start with you. Any general reactions to that very data-rich and fascinating conversation with Sven?
Yeah, Sven was chock full of data and charts in this presentation, so it was really good. And I'd just like to highlight some of these things. We agree with a lot of it. The hard thing is how to apply this, right? I get the sense that Sven trades a little bit more maybe than we do at New Harbor.
Well, definitely. He runs a TA trading service. So yeah, it's quite different than the standard client investing for the long run. So yes.
That's absolutely right. So he's held to a different standard, I think. I mean, he's more likely to be more all in or more all out. And he talked about getting out. And he listed a lot of really important data, I think, that is definitely a cautionary sign. He talked about a couple different things. First of all, the Russell, just the Russell 2000 all of a sudden just broke out of a base and had a huge Six Sigma move. That was unreal and frankly feels unreal. And we also had a huge move in the VIX. He talked about the volatility index. It had the biggest move in a couple of years very quickly, all while the S&P only went down about 2 point something percent. Now we are seeing a little bit of follow through today. Today is the 18th of July in the afternoon. The S&P at the moment is down around 45 points. So there's a little bit of follow through here. But if you look at some of those charts that Sven shared, and there were so many of them, I won't try to duplicate them here. There was basically a tag or a kiss against an upper trend line. Yet we haven't really had a throw over there. And we basically tagged them and then pulled off just a little bit. Now, there's a lot of reasons to be very concerned, most notably is valuations. Valuations are absurd. We've been talking about that for years, and I've got to admit that we were early, but it doesn't mean that it hasn't been true. The Fed has been able to keep things stretched and extended more than they ever have been before. They are very politically motivated, no matter what they say, and even Sven pointed that out. And so there really hasn't been much plan B other than more and more money printing. So that's caused a very abnormal market. There are some reasons to be near-term concerned. Sven talked about the Fibonacci retracement of the 1.618. It is an important Fibonacci. But if you stand back and look at a monthly, quarterly, or yearly chart, Sven admits this too, the little squiggles on that line can mean hundreds of points on the S&P. And the S&P is up 38% in the last 9 months, up eight out of the 9 months. All of this is true. So I said earlier, though, Sven, I think, is held to a different standard. Northman trader, he has to be in or out we really can't be that quick. And we admit to being early in terms of being cautious, but we're in the 40-something% range here in stocks. I mean, there's nothing really that's going to make us jump in 100% to try to catch the next few percent higher. We make some tactical shifts, and frankly, we added a little bit of equity exposure yesterday. It was only 2.5%, 3%. In a certain sector. So we are inching up ever so slightly, and we have our crash hedges in place. But Sven talked about this maybe in different words. There's real crash risk here. And even he admits that we can't say that the bull market is over until we see a big drop down to 4,800, 4,600. This is basically 1,000-point or 20% move before you can even be certain that this isn't just noise. So there's so much more here, and I've got a page and a half of notes. Stock market cap to GDP back up at 200%. These are nosebleed levels. Cyclical adjusted price earnings ratio up in the mid to high 30s. All of this is really, really concerning. Sven talks about cash. He talks about testing longs today, just because we had that big jump in VIX. And this has been a really good indicator for a short-term long trade the last few years. You got a pop in the VIX, you buy some stock, you might get a little bounce. My guess is we probably do get a little bounce here. But you have to have in your mind that you've got ever-present crash risk, and you have to have a plan about that. And we do with out-of-the-money put options down at 5,200 or so, and about 15% of our portfolio. So if we're 45% in, and this is just approximate, if we're roughly 45% in, and we have hedges down at 5,200 on 15%, that means on a drop through 5,200, we immediately go to 30% with our hedges. And then from there, we have other hedges. So we will pay a little deductible if we have a crash. Our best guess is that we haven't seen enough FOMO here. I wouldn't be expected to see, I would not be surprised to see a throw over on some of those channels that Sven was talking about. We kiss them. In a real euphoric market, you will get a throw over. And that maybe will mark the end of all of this, I think you and Sven were talking.
What is a throw over? Is that just a period of time where you trade above the channel, you don't really go back and retest it, you hang out for a while, and then you drop and punch back?
Yes, on the charts, if you remember that Sven was showing, he was showing some monthly charts, some weekly charts, and he had a nice trend line, and they were very orderly, just tagging the top of that trend line. A throw over would be a move through there, and it might stay there for a bar or two, and then collapse back down. That would be called a throw over. And that would be one sign of a euphoric parabolic top. I personally don't think we've seen it yet we're not betting on that happening. This has just been a massive distortion for so many years. I can't believe it going out with a whimper, but maybe it will. Maybe that's exactly what it needs. People like me to not believe it's over finally, right? But I think we probably get some kind of throw over in euphoria. Earnings coming up next week. It's going to be a big deal. One way or another. Netflix is tonight after the close. I guess really the first of the big tech companies to report. So for the layperson, I wouldn't even play around here. I mean, even if we get another 5 or 10% higher and then a reversal, for the most part, I'd be sitting in cash. Make sure you've got gold and silver. 10% of your investable assets is our recommendation for most people. Of course, everyone is unique, and be happy to talk to you about that. But gold and silver charts are looking great. Gold is right up against 2,500. Silver's at 31. I think they're going higher too. And even Bitcoin, that chart is looking like it wants to break out and go higher. So there's other things out there besides these, Mag 7 stocks and technology, et cetera. And we are starting to see a widening, right? We talked about that. Russell 2000, equal weight, S&P. So we have to see, is this a warning? Is the Russell 2000 blow off a warning of the end, or is this the beginning of a broadening? I think it's the beginning of a broadening that's going to give us that throw over or that parabolic move up in the next couple of months. Yet we're not going to change our allocation much, and we don't suggest people should either, particularly when Treasury bills are at around 5%. So I've been talking for a long time. I'll take a pause there, but thanks for giving me the opportunity.
All right. Well, so what I hear you saying, Mike, which you've been saying consistently recently, which is, hey, look, lots of reasons to be concerned. Sven mentioned many of them, but the momentum for now, at least, is still to the upside. The bullish trend is not broken. So no reason to say, hey, you got to break your allocation and just go fully to cash and defense. But given the fact that things are becoming more unstable, risk management takes an ever increasing priority in the portfolio. So I just want to remind folks that relatively recently, we did a video with you and your partner John on this channel talking about how to hedge against a correction using protective options. And so for folks that haven't watched that, given everything that Sven was talking about, what Mike just mentioned there, this would be a really good time to familiarize yourself with them because as the New Harbor folks already do pretty consistently in their portfolio, this is a good time to be investing in defensive insurance. And insurance is still, I believe, and John, I come to you next, so you can correct me if I'm wrong. Insurance is still relatively cheap. So not a bad thing to consider adding some more to your portfolio. One thing I do want to say before I hand you the torch, John, is if you have not dealt with options before and aren't already facile in how to use them, there's very speculative, i.e. risky ways to use options. I'm referring to the very defensive ways to use options. But if you're not experienced with them, highly recommend, even if you're doing just the defensive options, that you initially deploy them at least under the guidance of a good financial advisor, professional financial advisor who is experienced with them, because they're just the kind of thing that if you don't know what you're doing, you might make some rookie mistakes that could cost you. So let me hand the baton to you, John. But is it indeed still on a relative basis, relatively cheap to buy protection now?
Yeah, hey, great to be with you and great to hear Sven talk. Yeah, it still is relatively cheap, but not as cheap as it was. Sven talked about the sharp spike in VIX. VIX is a measure of volatility. Quite simply, and certainly we talk about this in the hedging video that you made mention of, one of the key inputs into the pricing of options is the market implied volatility for whatever instrument you're looking at. So it's gotten relatively more expensive, but it's all the context of what your objectives are, right? Just like folks whose house are closer to a hurricane zone or a flood zone than perhaps they were when they first got classified, still makes sense to pay for that insurance if you can get it, because the consequence is unacceptable. And in fact, most insurance policies have gone up in price over the years, regardless of that. So it's still deemed to be a good prudent use of funds, even if you got to pay a little bit more. So all situation specific, but a little bit more expensive, but still in the context of where we are in the market cycle and record overvaluations, and especially if you've ridden this higher and have a lot of risk still on the table, absolutely think about hedging. Never too late to think about protecting the downside. I don't want to go too deep in, the high points of the last week, Adam, we've touched upon them. The absolute blistering rotation from the large mega caps to the Russell 2000. I got to say, we have been on your program for the last month or so talking about the very stealth but consistent erosion of the breadth of markets, and that was something that kind of trickled in slowly but surely. The erosion, more or less in one fell swoop, all those signals got reversed, and that's not a healthy thing. In fact, the move over the last week is really not emblematic of a really healthy rotation. In fact, it was a brute force. There's a lot of evidence that this was likely driven by short covering. Hedge funds, for example, were really overweight mega cap tech stocks, really short, net short the Russell 2000. A lot of this move has the markings of that unhealthy kind, and we'll probably see some of that pull back. If you look at the move in the Russell, it was indiscriminate. There were almost every sector of the Russell 2000 was positive over that 5-day period. The standard deviations of the variations across those sectors were about as low as we've seen. Just not the healthy kind of change you want to see in a really durable rotation. But to the point of not running for the hills, just because one shouldn't run for the hills doesn't mean you shouldn't be more selective. There are some very stealth rotations going on beneath the surface here. We have looked at things like telecom stocks start to break out, healthcare stocks have broken out, financials have broken out. There is definitely, we think, some prudence in being more selective and being more tactical in the kinds of sector exposures that one should have. And of course, we were remiss if we didn't talk about gold a couple days ago, making a new all-time high. And probably even more importantly for our clients, because we have been overweight the gold miners relative to the metals. Since earlier this year, the gold mining stocks have strongly outperformed the metals. And that's a move that we had been anticipating for far too long, I will say, but that move has finally started to favor the miners over the metals. So very, very eventful week across the board.
Okay, and we're recording this on Thursday. One of the eventful developments of the week was pretty big sell-off in everything but the Russell, right, when that rotation happened on Wednesday. And when Thursday opened, there seemed to be a concerted effort for the market to recover those losses, which has failed. And at the time we're recording here, the day's not over, but markets are down, anywhere from 1 to 1+% right now. Even the Russell itself, right? It's the day in the 2/3. It's not really a trend, but it just shows that there's some froth coming out of the just sort of inexorable surge that the markets had of late. Maybe it's just the pause that refreshes and we get some wonderful guidance at earnings and we're back off to the races here. Maybe this is a great entry point for folks, or maybe this is a sign that things are beginning to peter out. Way too early to say in either one of those. But I just want to kind of combine that with Sven saying, there's enough weird stuff that we're seeing here that it seems like kind of the steady eddy, just, hey, we're just grinding higher month after month after month. That might still continue for some period of time here, but there's more uncertainty to it now than I think we've had in the past at least year and a half, since we bottomed in October.
I think Sven's swarm of locusts analogy was perfect, because that's exactly what these markets are doing. And one thing I forgot to mention, Adam, a key development over the last couple of weeks has been the absolute reverse course on interest rate communication. The Fed has been very subtle but very loud in terms of starting to turn course on their messaging. Powell was out talking about, hey, we're getting some progress on inflation, we're getting closer. And we had the good fortune of hearing Dr. Honig's comments on your channel last night. Great comments, and he spoke of his gut feel is that the reason there's a tonality shift, and in fact the markets have priced in this immediately, really. But he believes that the Fed is probably starting to get worried about the job market. And if you look at some of the jobs data, it's starting to signal some turn there. But I fear the market's gotten a little too quick. Right? Look, we're humble. There's nothing we'll ever say with 100% certainty. But yesterday, the market was pricing in 0% chance of no rate cut at the September meeting. I can get 1%, I can get 0.5%, but zero, literally zero. And already the market's reassessed that a little bit, but there's a lot of things that have moved on that interest rate forecast, and I think the market's got an implied forecast of 3 cuts through the end of the year, and then another 3 by next July. Might be getting a little ahead of itself, just like it did late last year when the market started pricing in 6 to 8 cuts when the Fed was saying, oh, well, wait a minute, we think 3. So I'm a little concerned about how quickly the market has reassessed the interest rate picture.
Okay, Mike, I'm coming to you in a sec to talk about just any portfolio changes you guys have made recently. But John, I just got to express my exasperation here, which is, and I agree with you, if indeed the market is saying, hey, we think that Powell is closer to cutting, that's great. We think, that makes us super excited that asset prices are going to go higher. I'm just like, wait a minute. If it's weakness in the labor market that has got the Fed worried enough to start saying, hey, we might start cutting rates at a time where stocks are at all-time highs, real estate's at all-time highs, unemployment is still relatively low, all sorts of conditions that are generally not associated with rate cuts, then you got to assume their fear is pretty big, right? So those are things that are not good for economies. And I won't show it here because I've shown it so many times, but like typically when we go into recession, the unemployment rate is the last thing to start moving. And then when it does, it moves very quickly, right? So if the Fed is worried that we're in a state where unemployment can get out of control quickly, that's a real warning sign that the economy is going to a bad place. It's not a time to be getting super excited that, oh, asset prices should shoot the moon.
Yeah, exactly. And add on top of that, that the forward projections for earnings growth are actually quite strong. And these are just projections, of course.
They're
And
like
that's
20%, right?
Yeah, and that's not harmonious with an economy that is requiring emergency cuts because the job market's falling apart, right? Something's got to give there.
Yeah, it just look, we'll see what happens. And again, the thing I hope people take away from this whole video with Sven is nobody here is saying this is it, assume the crash position. So don't do anything extreme. But you just get frustrated with what appears to be very magical thinking that is driving the market action. All right, Mike, as we wrap up here, have you guys? I think you mentioned that you maybe put a little trade, a long trade in a new sector. Anything else you've done in the portfolio over the past week or two?
Not really a lot in the last week or two. I will mention the one that we just did. We did see those reversals up in our short-term indicators, the bullish percents that Sven just talked about. They reversed up the other day. Ironically, the next 2 days were straight down. That would be the last couple of days. But we are always looking through different sectors. We're looking through all the S&P sectors. We're looking at charts of them all. We're looking at relative strength of each of them. And we often use low-cost ETFs to represent sectors. And so we've got a number of different sectors on, and none of these are very big bets. A lot of them are 2.5% or 5%. And on the recent reversal up, we added 2.5%. We happened to add it to telecom. So taking a look at the telecommunication sector, it's not something that we would have thought of on the top of our mind, but something that we see when we look at the various different charts. And even in the sell-off the last couple of days, this has held up pretty well, and it's right about where we bought it. So we'll see if these last couple of days is actually the kickoff to a much bigger bear market, or is this yet another pause that refreshes? We don't know. But we're up in the 40s, mid 40s or so in equity percentage. And we have the hedges on that I told you about, the out of the money S&P put on 15%. But the one thing I didn't mention in my recap of Sven's talk that I thought was really spot on is Sven said nothing matters anymore. And it's been that way for so long, and it is very exasperating. There's nothing that says that this is sustainable. 200% market cap to GDP. We know how this ends. It ends badly, right? Except it hasn't this time. History tells us what's going to happen from here. But we don't know until it happens, and we haven't had any confirmation. And so, even Sven says, I'm not calling for a crash. We're not calling for a crash right now. We think there eventually will be one. And I know that sometimes that sounds like a little bit of a cop-out, but I really feel like you got to pick your spot now, which is why we're 40-something% in equities with hedges, because a lot of the rest of that is in cash earning 5%. And a lot of viewers should be in for a good portion of what they have anyway, if they don't want to play around in the very, very late stages of this bull market, which may already be over, but my gut says it probably isn't. So yeah, this time has been different. It really has been, for longer than it ever has been before. But I don't think it will stay different. I really don't. And so we've got our eyes on the ball, and we are where we are. We see some opportunities. Telecom looks good, but a lot of other sectors look good too. And we'll see what happens. We'll talk about it next week.
Okay. Yeah. Well, just to remind folks, we'll have you on, week after week from here, so you'll keep folks updated on what you're doing. Two quick things, then we'll wrap it up. One is to your last point there, Mike. I'm reminded of what John Hussman said when he was on this channel a few weeks back, where he said his main advice to investors was determine your acceptable level of regret, right? So what's the move you can take that if it goes against you, you're not going to have, too painful a regret over, right? And that might be, hey, I'd rather miss out on another 5 to 10% run in the markets because I got a little too defensive too early, right? That might be it. Or it might be, oh my God, I got defensive too early and I missed a great run, right? And you have to determine which one of those you can live more with. And so I just think that's a good guiding principle. And you were nodding your head here, Mike. I think that's exactly what you guys are doing and encouraging people to do as well. Secondly, just prefacing this is not personal financial advice for anybody, but are you able to share the ticker of the ETF, the telecom ETF you guys bought?
Yeah, absolutely. Again, the caveat is not individual advice, not a recommendation. We're happy to have an individual conversation with anybody to see if any of this is suitable for you. But having said that, in our model, we put on XTL, Spider, S&P Telecom ETF, X-Ray, Tango, Lima.
Okay, great. I just know that people were going to be asking like crazy in the comments section if I didn't think to ask it of you. All right, gents. Well, look, thanks for another great week. Real quick wrap up here, folks. If you enjoyed having Sven on, would like him to come back on the program when his TA is telling him that something else material is happening, please let Sven know that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. I think we're at this point maybe like 1.3, 1.2 thousand away from our 100,000 subscriber goal. So if you're watching and haven't subscribed yet, please take a second and do that. It'll really help us out to hit that 100,000 subscriber milestone. And then, yes, if you want to take action based off of anything that Sven and I talked about, whether it's the short-term technical stuff or the much longer-term how to position for this, he said unreasonable economy and market that we have. I highly recommend that most of the people watching this video do that under the guidance of a good professional financial advisor who understands and takes into account everything that Sven and I, and then John and Mike and I have talked about here. When you put those requirements together, they got to be good, they got to be a professional in good standing, and they have to take into account these macro level issues. The universe actually shrinks to a relatively small number of providers who do that. But if you've got a good one of them, great, stick with them. But if you don't, or you'd like a second opinion from one that does fit that set, perhaps even John and Mike and their team at New Harbor Financial, then consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. To do that, just go to thoughtfulmoney.com, fill out the short form there. The advisors will be in touch very quickly thereafter. Just as a reminder, these consultations are totally free. There's no commitment, no strings attached. It's just a free public service they offer to try to help as many people as possible position as prudently as possible today for what might be coming. By the way, while you're there at Thoughtful Money, if you have not yet signed up for our free newsletter, just click that newsletter link up at the top and sign up. Again, that's totally free. There is a premium service that there are other benefits for, like getting private audiences with luminaries like Dr. Thomas Honig that we mentioned. But again, to initially sign up, it's totally free. With that said, John and Mike, thanks for hanging with me for yet another week. Look forward to seeing you guys next week. Everybody else, thanks so much for watching.